Hi everyone, and welcome to this week's installment of Mish's Market Minute. I am your host, Mish Schneider, and as usual, I have an action-packed half an hour to fill with you guys, so let's get going. Because the financial sector has been in the news this week for many different reasons, we're going to explore that, I thought we would completely focus on that sector. So we're going to do an in-depth look at all of the aspects of the financial sector, from insurance companies to banking to credit card companies. And what we'll be looking for really is chart patterns, but also any kind of divergence in terms of the momentum using the real motion indicator. I want to start out, tell you a little bit about the Volker Rule because it's actually very interesting. Then we're going to go through the sector ETFs, go to the big banks, the regional banks, and other financial services. So I actually wrote out bullet points for the Volker Rule because I wanted to make sure that we understood the impact here. Now, first of all, as you know, I did a segment for you guys a while ago on comparing what's going on now with some of the issues that we had in the 1970s, and Volcker was the Fed chairman in the 1970s, and he became famous for squelching that inflation that we saw, that I've been looking for and talking about, by raising the rates to really, really high. And at that point, the banks were still allowed to use savings to make investments. And so we've had periods where that has turned into a bubble. Like, for example, the biggest one would be during the Depression. When the banks went belly up, so did everybody's savings. And then after the mortgage debacle in 2008, the Dodd-Frank law was passed, in which Volcker was part of that, the Volcker Rule. And that, of course, was after the mortgage debacle. And that was, again, to stop big bank risky behavior. The ripple effect of the mortgage crisis was Bear Stearns, for example, going out of business, Lehman Brothers. So now what happened today was that they rolled back the Volcker part of the rule, which allows banks to make investments into venture capital and derivatives trading. So essentially what that means is banks now will be able to make investments with money that they have, and that would include money that they see fit based on the savings that are in the bank. And basically what it does is it frees up $40 billion in assets. So the positives to that is that banks now have the freedom not only to make more investments even in the market, but to make more investments in businesses. And of course the negatives is when the you-know-what hits the fan. Of course are we fixing one bubble by creating another bubble and putting our money then again at risk? So that's the question going forward. Now, also on Thursday, the banks are getting a stress test. And the first headline that came out was that the banks were healthy enough to withstand COVID-19. But then the Fed, see, the government giveth with one hand and the Fed taketh with the other, then decided that banks had to cut their dividends back to second quarter dividends and stall or stop any of the buybacks that they were doing. And so in the aftermarket on Thursday, after the big rally on the Volcker, the banks set back a little bit in price. So let's start by looking first at the broad ETFs of both the financial sector, which includes more of the big banks, that's XLF, and KRE, my regional banks, or my very famous prodigal son. So let's first start with the XLF. Now, I think what you're going to see over and over and over again is the redundancy of how these charts look. And that is not to bore you to death. That's really to show you just how critical the financial sector of the market is to not only the economy, obviously, if they have the money now to make some investment, but really to the stock market itself, because we know the stock market and the economy don't necessarily meet eye to eye. So what we have here is the XLF. And of course, it's well underperforming the market. We'll look at that in a moment. But today was a big day because it tested, today being Thursday when I'm recording this, it tested the 50-day moving average. It held it and it closed above it. So would I say we're out of the woods on that? No. But what is interesting is that after this big run up, we are starting to see some level of support. And again, you have to look at areas. You can't look at a line in the sand exactly. Like, we can't say, oh, if it breaks 2282, that's it, it's over. You got to give it an area, number one. And number two is the closing levels are extremely important these days. But we want to see these financials get better because we, being investors, nothing to do with social conscious or whatever you stand, this is strictly from investing purposes, we need to see this start to outperform the SPY, or at least go in terms of par performance with the SPY. But what is interesting is that we are holding the 50-day moving average on the real motion chart. We're not necessarily getting a divergence, but what we are seeing here is that the real motion actually increased a little bit in momentum. So I would be looking at this XLF at the broad ETF really now to see if we can get back over, say, that 10-day moving average around that 2380, and I think that would be a really good start. Now, KRE is a little bit weaker. This is the regional banks, a little bit weaker on the price, definitely on the price performance and on the momentum. But this broke the 50-day moving average on Thursday and then came back to close above it. So once again, we've got levels. We've got 37, which is really what we want to see hold. And then I would like to see this get back through. It says 39.22 is the 10-day moving average, but I would say between 39 and 40, really that's going to be your area. And that's not a bad do, by the way, if we believe that the banking industry can improve as a result of this, is to be a buyer over 39.40 with a risk to under 37. But again, we want to see this start doing better in terms of its performance, at least get through this Bollinger line that we have here. And then, of course, on the real motion, even though this broke the 50 today in price, this held the 50 today and also increased in momentum. Now, I wouldn't say that makes it a screaming buy, but it certainly makes it interesting. And I can't say enough, it's such an important piece of the puzzle. We need the financial sector to participate in this rally way more than we need NASDAQ and the FANG stocks. Okay, so now let's look at the individual big bank stocks. I've chosen JP Morgan, Bank of America, Wells Fargo, Citicorp, Goldman Sachs, and Morgan Stanley. And you'll see there's a little bit of difference in these. By the way, JP Morgan, of course, looks pretty much like what we just saw with the KRE. It had broken down yesterday being Wednesday under the 50, and then on Thursday started out that way and closed above it. So again, this is why I talk about areas, number one, on a phase. Number two is let's remind ourselves that the slope here is slightly starting to turn up. And number three is you need a 2-day confirmation in order to say we have an official phase change. So we didn't break to a bearish phase with a confirmation, and we can't call this a recuperation phase without a confirmation, which will make Friday a big pivotal day. We're still well underperforming here against the SPY, and again this held the 50 when it broke. So the momentum on these, the best news is so far we're not seeing a huge divergence, but we're seeing a slight divergence. And if we go on to the Bank of America here, this never really broke the 50. It did today and then came back and closed well. And again, look at that same divergence we're seeing here in the real motion, starting to improve a little bit, but certainly not outperforming the SPY by any means. And again, very similar type of levels here that we're looking at in all of them. Sitting on that 50-day moving average really needs to get its butt in gear. And to me, that 10-day moving average, which also, by the way, has a neutral slope to slightly positive, if that clears, that gives us a much better opportunity. Now, Wells Fargo looks a little bit worse. Now, but again, even though we broke the 50, we cleared it today. So we've had no confirmation on the phase change. The 50-day moving average is more neutral than up, but that overhead 10-day still looking pretty good. And again, real motion showing a divergence. In fact, in some ways, a better divergence here. So I would keep my eyes on Wells Fargo just in terms of divergence. But again, I can't remind you enough, wait for the confirmation in that on Friday. It would have to close over that 50-day moving average. And then you have good tight risks. If you wanted to take a shot, I would risk just under the low of Thursday with a little bit of fudge, of course. Now this is Citigroup. Citigroup looks even better than the others, which is why I wanted to show you this. Number one is it did not get down to the 50-day moving average, which is that blue line. It scraped it, but it held it. And now you can see that it looked like it was going to break down under 50 today. That's a nice pivotal number here, and instead closed up. So really, basically, we're talking about a little bit over today's high and the 10-day moving average, maybe you could risk tight under 50, maybe even more under 48 if you wanted to use the 50-day moving average, which I would recommend. And that's not a bad risk reward. I haven't really talked about the risk reward in any of these, because if they hold and you're going to risk a couple of dollars or even $4, the question is, can you make 8? And the move from 52 to 62 is actually more like 10. So that's why I decided today that with all the news, the financials, which I haven't traded, by the way, in a really long time, are compelling. Now, in terms of the actual price performance, this is actually doing better. You can see it's starting to match the SPY. And momentum, no divergence here, really. It's held above the 50. And of course, what we can see here now is we'd like to see this clear that Bollinger Band. Now, if we move on to Goldman Sachs, that looks better. So look at that. Today, today again being Thursday, it actually scraped the 200-day moving average and is trying to take it out after being there on that last big rally. Has no gaps really. We have some islands in the SPY in that we had a gap up and a gap down, but we do not have that in Goldman Sachs. So that's a good thing. We filled that gap. So now what we want to see is this slightly closed above the 200. That would put it into an unconfirmed accumulation phase. So now we want to see the confirmation of that accumulation phase, or in other words, another close over about 204.50. Now, this is outperforming the SPY. And in terms of the momentum, look here. So this would give me a little bit of pause. There's no divergence, but there's certainly, we'd like to see some divergence in that we would like to see this start to move up above that 200-day moving average. Now, Morgan Stanley looks the best of the banks. Now, Morgan Stanley, by the way, has, and Goldman Sachs have a big investment part of their banking. So it's not just a regular old big bank. It actually is also an investment firm. And so as such, that Volker Rule rollback today would be a benefit for them. And so look what happened here. You got down to the 200 twice and held, kind of like what the SPY did, although the SPY tested the 200 today. And now look what happened here. We had actually what is called a bullish engulfing pattern over the last 2 days. This whole body of this candle engulfs the body of the candles from the 2 days before. Candlestick chartists will tell you that's bullish. I would actually want to see this clear 48.70 or right over Thursday's high in order to keep going. But it has potential. And now over here, you can see it's well outperforming the SPY, and the momentum is not really wowing me yet. So you can see this peak here, right here, relates to this peak here. So we want to see this actually move up in momentum. Now, that doesn't mean that it's a deal breaker. It just means that generally the way I'll use it is if I have a straight divergence, I'll still wait for price to match up. And if I have a divergence like this where the price is doing better than the momentum, I might still do the trade, but I would do it more with a smaller position size. Okay, let's go to some of the regional banks. So let's first go to PNC. This is PNC Financial Services. And so essentially all these financial services, some of them deal with institutional investors, some of them deal with more of the retail space. PNC is very weak. Okay, look at that. It's still in a bear phase, under the 50-day moving average. But the good news is, number one, is the slope on the 50 is up. Number two is, look at that, we had an inside day. So you can see Thursday's range is inside Wednesday's range. Of course, I would probably wait for a move over the 50-day moving average, still well underperforming the spider. But look over here. This actually is sitting on the 50-day moving average. Here's your divergence where this is under. So there's a couple of rules involved in this. It really depends on what type of trader you are. One is you wait for Wednesday's high on an inside day. You wait for the outside day to get long, and then you have a tight stop. One would be to just wait in general for a 2-day close over the 50. But the divergence is compelling. Now this is KeyBank. So KeyBank actually is very similar in that it does a wide range of financial products. Also now doing way better than PNC, sitting above the 50-day moving average, trying to match here on the SPY performance, and has done well in line really basically, and no divergence here in the real motion, but getting right up to that Bollinger Band which you want to see clear. So again, you have a nice little area here of support forming against that 50-day moving average, and you really want to see it take out that 10-day moving average at 1329. Now, when I say these are redundant, I'm not kidding. This is Fifth Third Bancorp. So when I'm talking about the divergence, that would really be your clue maybe to be the ones that you would look at based on the parameters I mentioned to you for a potential swing trade. And of course, what I haven't mentioned is that all hell breaks loose and these fall apart, then your obvious opportunity would be to wait for these 50-day moving averages to fail, especially the ones that failed on Wednesday, came back on Thursday, and then you would have a good opportunity potentially to go short, or at least go short the financial sector ETF. So this is Fifth Third. And this is also kind of similar, this is kind of similar to what we're seeing here in the 50-day moving average, holding above it at 19, still underperforming, and above it in the real motion, but now wowing me either at this point. And that makes sense. These regional banks have been weak. And now we have Capital One Financial. So they do credit card, consumer banking, commercial banking. They only exist in the US, United Kingdom, and Canada. Sat right on the 50-day moving average today. So we could call that a test of the phase. So that means now you have a really good clear point to look at 64.22 on Friday, not wowing us here, and certainly not wowing us here, but the momentum, which is well above the 50, is still doing better than it being on the 50-day moving average over here. So now you could probably look to see what happens over Thursday's high. And then we have now the other financial services to look at and see how all of this compares. So what we can see in the big banks is that the banks and the regional banks have very similar charts. Some are outperforming the others, just to kind of sum up here. Divergence is better on most of them. Some of them they're in par. And of course, Morgan Stanley and Goldman Sachs probably, because of the investment arm, look the most interesting. So now I wanted to take a look at some other financial services with you, including a couple of foreign banks. So this is MetLife, and they do insurance, but they also do annuities. They provide employee benefits, asset management businesses worldwide. So they are also in somewhat of the investment game. But of course, we know them mostly for insurance. And so right now, same kind of picture we just saw in the last chart, sitting right on the 50-day moving average. Really, I mean, for me, that is just so technically beautiful. Why? Because you're sitting on an upwardly sloped 50, number one, and number two is you know right away when you're wrong, and this is where discipline has to come into play. So if it breaks down under 35.25, not only are you wrong if you decide to buy, you have again an opportunity to potentially go short. And if you did go short, by the way, you would look for a move probably down to around 30. So you could again risk tight over today's high, break down under 35.25, excuse me, and then look to see if you can get a couple of bucks down to about $5 on there on a short. I don't want you to think that I'm only into buying, but one of the things that I like about all these charts that I haven't pointed out, so I'm going to point out now, is you had your low here in March, you had a higher low here in May, and now potentially getting a higher low here yet in June. June, which everybody says is so nasty for equities. Forget about all that talk you hear. I've got to tell you that all the rules have been broken. There's nothing typical about what we see in 2020. So now let's just move down here to the real motion. Again, slightly outperforming because it's above the 50 where this actually sat right on the 50. So now this is Synchrony Financial, and it's considered to be one of the top Financial Industries. They do a lot of banking products to the digital space, retail, home, auto, travel, health, and interestingly enough, since you heard my dog bark, the pet industries. And they also provide private label credit cards, so you can get a credit card from them, just like you can with MasterCard and Visa and Citicorp, all the banks, Bank of America, etc. Of course, what's frustrating is that they have not lowered their interest rates to consumers, which is something, of course, we would love to see. I think that would be a real boost to them. But of course, that's just my opinion. Doesn't mean anything. So now let's talk here about Synchrony Financial Chart. This is doing better as well, which doesn't surprise me. And so again, we have a level of support here at about $21.50, but you've got your 50 right here at $20, again sloping up. But I see a divergence here as well, at least with the performance, which is well underperforming the SPY. And of course, even though it's holding above in the 50-day moving average on the real motion indicator, it still hasn't cleared this Bollinger Band right here. So I would say I don't see any divergence here. So it wouldn't necessarily be my favorite trade that I've showed you. But on the other hand, if it started to break down, that would be interesting information. And if it holds and rallies, also interesting information. Now this is American Express. Now, you're going to see the difference here between American Express and Visa when we get to it. But it's that same thing I keep showing you. A low here, a higher low here, a higher low here. And if this turns out to be the low in June, a higher low here. And of course, no coincidence. Look where they're holding. They're holding above their 50-day moving averages. Now let's go back a little bit in time here, because after we had that big collapse, it waffled around. It tried to get through the 50. Look at that. Didn't confirm. Remember I told you 2 days above the 50? Not to mention the slope here is negative, so it wouldn't have been a very compelling move up anyway. Then the same thing, you had a 1-day move here, and then boom, you made that higher low. And so when you cross the 50 here and the slope started to neutralize, this is a recuperation phase where you go from the 50 to the 200. You take profits, of course, along the way. You might even get super excited, although it didn't close above the 200 this day. Then it did this day and then closed below it the next day. So you see how important those 2-day confirms in. So now that trade would be over for you. So now we're getting that perfect retracement back down to that 50-day moving average, which is why this is such a good topic for us this week. Now again, underperforming the SPY and outperforming on the real motion, because we basically almost touched the 50 today, and today we are actually moving up a little bit in momentum. So we'll see what affects the market first tomorrow. Is it going to be the good news about rolling back the regulations, or is it going to be the badder news, if that's a word, about the fact that they're now decreasing their dividends and are not allowing any corporate buybacks? So now let's look at Visa. So Visa is a little bit of a different situation here. Visa is actually had a bullish cross, or what we call a golden cross. So let's go back a little bit in history here when this was crashing. Nothing survived that February crash. And one of the things I want to say is people have been asking me lately, why are you bearish? The market looks like it's going to go down, yada, yada, yada. Well, I have several reasons for that. And one of the reasons is that I wouldn't say I'm not bearish, but I'm certainly not thinking that we're going to see this type of devastation unless something beyond COVID-19 happens. So this really caught the market by surprise. We were sort of like, yada, 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 COVID's in China, we don't care. And then when it became the reality of how it was spreading, the market just went into a meltdown. But now the second wave is not necessarily unexpected. And plus, unless we see a real increase in the death rate, not the case rate, but the death rate. And when I say increase in the death rate, I don't mean we don't want to see people die, because people will die. People always die. But how it relates to the first wave's death rate, if that death rate starts to increase, that I think would be a devastation and a surprise to the market. But if we look just here at the Visa, which is a really good thing to track, by the way, because most people have a Visa card, then when the market started to come back, this did the same kind of thing. It got through the 50, but it really wasn't until it started playing around at the 200 that you had that big move up here back up to 200. So the fact that this has come off since then is not a great surprise. This doesn't look bearish to me. This just looks like a correction after this huge move that we had, literally from about 100 to 200. So even if we came off 50%, which I really don't think we're going to, but if we did, even still be constructive. So as again, unless something crazy happens that we cannot expect, and I'm just talking for the time being, right now, this looks okay to me. Golden cross happens here. I don't like to trade a golden cross when the price is too far away, but we are getting closer to the 50. So keep your eye on this as well. It's slightly aligned with the SPY, and it's over the 200 in momentum, but not, look at this, divergence. So the momentum here isn't nearly as strong as what the price is. So I would be careful necessarily buying Visa, but again, I like to have ones that I'm interested in buying and then the ones that I'm using for information, because that information is going to tell me exactly how much to risk and how much to buy. Okay, I wanted to show you Banco Popular. And Banco Popular, by the way, so a lot of people in New York I know used to bank here. And their main quarters are in Puerto Rico, but they also provide various retail, mortgage, commercial banking, and they do have obviously branches in U.S. When I lived in New York, as I mentioned, it was the first time I heard of Banco Popular. In fact, back in the day, they used to do commercials for Banco Popular. So this is like a classic regional bank. Now, look at what, oh my goodness, come back. Look what's happening here in terms of the actual phase. What do we see? It is under the 50-day moving average. It actually confirmed back into a bearish phase. A bearish phase is when the 50 is under the 200 and the price is under the 50. However, it's a weak bearish phase because look at your slope here on the 50. It's actually kind of up. So we can keep an eye on it and look at the divergence down here, guys. Whereas we're under the 50 here, we're above the 50. So again, I'm not saying every single one of these charts I'm showing you is a buy signal. I'm really trying to train your eye to find these divergences in real motion, to look at a whole industry, and then find the outperformers, and then decide based on all the information whether you want to be a day trade on it, you want to have a mini swing trade on it, or you want to have a swing trade on it, which means you have your risk, you get in, and you hold it for certain parameters, and of course obey your risk and then take your risk out as it starts to move in your favor. Now again, just like every other chart, low, higher low, and higher low still. So that's why I don't let that worry me too much, especially when I say that I mean the break under the 50, when I see the divergence here in this 50-day moving average. And the last chart I'm going to show you here, this is Lloyd's of England, and this is such a little fascinating story, and that's why I'm showing you this chart, because it's kind of like the PS of this whole rollback of bank regulations. This was the classic. This was the largest bank in Europe for a while. They were involved in commercial banking, insurance, and wealth. It was really basically a huge blue chip company. And why did they blow up? Because of speculative investing. So there is replace one bubble with another bubble. Now, so far, except for the initial bubble of COVID, we seem to be waltzing around all these bubbles, which is great. But this chart I'm showing you because I want to remind you that things aren't always great when they roll back regulations, because as you know, the reasons why they were put there was after the mortgage debacle. But on the other hand, as I said, at this point when we need capital, it's not the worst thing in the world to do. So let this one be a lesson to you in terms of getting too complacent. And by the way, this isn't the last chart. I do think I have one more chart after this. So now we're holding right here on the 50-day moving average. And where's my cursor? Here it is. And so here's your 50-day moving average. Talk about a squeeze. Now, of course, this is a really cheap stock. Look at us. This is trading at 155. Inside day on the 50 But if you can get through these levels right here, again, would I necessarily be out there aggressively buying this particular stock? No, but it tells me that the comfort level, the speculative comfort level in trusting that the banks aren't going to do anything crazy, like speculate our money into investments that make us then go belly up, that at least for now, that's a good sign. Not doing too badly against the SPY right here, and also look at the divergence, doing better in the real motion. So again, watch that financial district very carefully. Watch the ETFs, watch all the stocks I talked about. Send me any questions, make comments on the StockCharts TV YouTube page. I answer them all. And thank you so much for bearing with me for the last half an hour. Bye for now.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.